this? Let's say a recession does eventuate in the US. What do you do? Do you stick with equities, or is there perhaps more competitive return in treasuries right now? How do you trade around this?
Well, I'm not sure I agree that rate cuts will come as soon as they should. They should come relatively soon. But the issue is that the central bankers are looking at the wrong things. They're staring at the wrong gauges in the car. They're looking at oil pressure when they should be looking at RPM or at the tachometer. In particular, the R-star models, the Phillips curves models, that stuff is just gibberish and really shoddy econometric work. It's nonsense on stilts. They need to be focusing on credit and money and the expansion and contraction and that. So to answer your question, what I think is going to happen is I think we're going to have to go through some pretty rough economic times for a while before the Fed and the ECB pick up on the gauges they're using how bad the economy will be. And then at that point, rather belatedly, we will get the cuts. And at that point, of course, risk assets will probably rally. And it will probably be a pretty good time to own long duration government bonds. But in the meantime, real rates have been surging. And I think that's because the fiscal balances that we're looking at as these economies slow down, the amount of government debt issuance is really quite enormous. I think we're going to have $1 trillion of U.S. Treasury supply in Q3. And to absorb that without central bank buying is really difficult. And so I think ultimately in time, we're going to be forced back into central bank bond buying. That's going to end up happening because I think we're going to have some pretty ugly deficits, and we're going to need to keep the real rates under control. But all of this will play out in time, as I say.